expecting that was the same for everybody else. So I'm one of the partners over at the firm at Vanguard. We're an employee benefits firm, and as Ed was starting to mention, we run these bi-weekly lunch and learn meetings. And today is going to be a great meeting with Jim and the team over there, talking to us about.
Hudson, can you come here, please?
If everybody wouldn't mind just muting, just in case there's any background noise that might pop in. Just kind of mute yourself out. There's a little microphone. You click it, and it will mute you out. Ed was mentioning, we'll field questions throughout. If you haven't used Zoom before, there's a chat. There's icons down at the bottom of your screen, a little blurb, like a message blurb. You click on that, you'll be able to chat and ask us any question throughout the meeting. Ed and or I will manage that. Are you back?
Hello.
Maybe not. So
I am back.
Yes,
sorry.
it's like tag team wrestling back in the day. Ed, I'll tag you back into the match.
Are you able to hear me?
Yeah, not wonderfully, to be honest with you. I think I think we got covered on what we need.
Yeah.
Really. So
Two heads are better than one. I apologize
Yeah.
to all. So thanks for jumping in.
Yeah, I got you back. We're all good. So every couple of weeks we'll have a meeting like this. This will be recorded. So the funny stuff so far today will be recorded, and it will also, the important pieces will be recorded as well. And we'll make this available to everybody, and it will be stored in our archives on our website as well if you ever need to go back to this, or if you have colleagues that would want to learn more about this information. So I'm going to, at this point, I think it's time to get started. So Jim, I'll give it over to you. I'll go back on mute, and I'll jump in as necessary if you need me.
All right, Tommy, can you and everyone else hear me okay?
Yes, we can.
Everybody good?
Yes.
Okay. So we're going to talk about Social Security as part of the retirement landscape, as a defined benefit plan, meaning that you know what you'll get and you'll get it for the rest of your life when you do make an election. The retirement landscape had many defined benefit plans over the years, and they've become somewhat of a dinosaur. So Social Security, as a piece of that puzzle, has become even more significant, and the decisions you make can have a huge impact in your retirement. So Dave Freitag, who I'm going to introduce, is going to run through the deck. We have a lot to cover. We want to make sure we get to all of it. And I think, as Tommy said, questions can go to Ed in the chat, and we can address those at the end. But Dave, why don't you take it over from here?
Well, thanks, Jim. Again, I got the dreaded screen warning that the internet is unstable. Of course, I'm in the western side of Boston. We had a terrific windstorm here yesterday. So hopefully Jim will be able to get through this. Jim, are you able to hear me okay? I just want to make sure that we're communicating to everybody.
All good, yes.
Okay, great. So this is the guy on the other end of the phone here, and Jim and I have worked together helping clients make good decisions about their Social Security planning for the future. I think the key thing to remember is that we want to have a little fun with this particular meeting. We want to talk about some facts, a little history, filing strategies, things your clients need to consider, touch briefly on taxes, and kind of sum things up. Of course, anytime you do a meeting like this one, there's always some notes from the compliance folks. And here are some of them that are really important. That we're trying to look about very generalized backgrounds here. If you had specific questions, obviously they need to be directed to the local Social Security office. Sherry, you need to turn your mic off, I think, if you can hear us. Information is current with the laws that they exist today. And ultimately, the decision for taking Social Security rests with the clients. But the part in red is really important. And that is when you start your filing process, you open a window. And you can make a change for 1 year. That window is open only for 1 year. And after that window closes, making filing decisions for Social Security becomes extremely difficult, or in fact might require you to repay benefits. So I'm so glad everybody is joining us today, because you want to be prepared to make the right decision the first time. And of course, always we're not providing tax or legal advice here with this presentation, which means we need to go back in time in 1935 and see FDR signing the Social Security law. Now, Jim, what do you notice about this particular picture that sort of jumps out at you?
Well, for one, there's only one woman in the picture.
Yes, there's a lot of old guys and one woman. And the reason that that woman is there is that's Frances Perkins. Frances Perkins was the Secretary of Labor for FDR when he was the governor of the state of New York. He was so impressed with her thinking and visions for the future that he brought Frances to Washington, D.C., was the first woman appointed to a U.S. cabinet position, held the Secretary of Labor's job longer than anybody. And the reason she's in that picture is that Frances and the committee that worked with Frances wrote the Social Security law. But it didn't stop there for her. She also authored concepts of unemployment insurance. Think about 2020. My son is on a furlough right now. My daughter is on furlough, collecting unemployment compensation in 2020, yet it was the vision of Frances Perkins in 1935 that introduced this idea as a government benefit. How about workman's comp, the minimum wage, abolishment of child labor, established the CCC, the Conservation Corps. For many of you who go to national parks, you can see work that she founded, back in the day, and we don't even know who she is. But the folks in Washington, D.C. know who she is. They named the Department of Labor the Frances Perkins Building. It's the one there on the left, the square one. And if you're in Washington, D.C., I urge you all to stop in and go to the museum and learn about Frances Perkins, because if there are two legacy programs that we have today in this country, one of them is certainly Social Security, directly responsible by Frances Perkins' forward thinking. And the other one, Jim, is on the front door of every bank that you walk into. It's 4 letters. What are those 4 letters?
Good question, Dave. Why don't you share that?
Did you hear me, Jim?
Go ahead.
Yeah, the 4 letters, FDIC, right?
Yes.
So the FDIC, the Social Security Administration, legacies from the New Deal that are part of America's DNA. It's in our bloodstream. Imagine what the country would be like today without Social Security or the FDIC. It would be a different place. So it's important. Way back in the day when Social Security started, it started as a lump sum payment. Kind of amazing. And Jim, I know you've seen this slide before, but here's our friend Ernest Ackerman, the first one to receive a lump sum payment from the Social Security system. And this is a quiz. So Jim, if you hadn't seen this slide, what would you have guessed that Ernest received in a lump sum payment based on his Social Security contributions in 1937? What do you think?
I would have said $95.
Yeah, I would have said, but that would have been way too high, because the answer is actually 17 cents. Ernest retired shortly after the Social Security system started collecting FICA taxes. Basically, he paid 5 cents. He got a lump sum check for 17. And to put that in perspective, you walk down to the local post office, you could buy a first-class stamp for 3 cents in 1937. But clearly, the lump sum payment system was never going to work. And so by 1940, it had morphed into an annuity. And everybody on this call knows that an annuity is paid once a month if you're alive, as long as you live. And Ida Mae Filler was the first recipient of that first annuity check. Aunt Ida, they first called her in Ludlow, Vermont, paid in $24.75 in FICA taxes. She received $22.54 in the monthly benefit check. If you look closely at that picture, you could probably see that. But Aunt Ida knew the secret sauce relative to annuities. And that secret sauce is longevity, because she lived until she was 100 years of age. And that was pretty amazing in 1940. As a result of that longevity, Aunt Ida collected $22,000 in benefits from the system. We're going to talk about the importance of longevity later during our discussion together, but this is an absolute fundamental reality check on maximizing Social Security. It must consider longevity. It plays a critical role in making that decision. Oh, by the way, Jim, back in 1940, for $800, you could buy one of these. What do you think one of those would cost today?
Yeah, a few more, I would say, yes.
And it's all chrome. It's just an amazing thing. How much chrome is on that? But anyway, that was a Chevy, 1940, $802, right up there in good old Ludlow, Vermont. To put things in perspective, the system has changed. And let's talk about how it's changed, because at the end of 2019, there were 64 million people in this country collecting benefits from Social Security. And Social Security is really three independent, different programs, related but independent. First of all, there's 6 million people collecting survivor benefits from the system. A newborn baby could actually collect Social Security benefits. How? If one of their parents died. For younger people, for younger workers in this country, they need to understand that it's not always about retirement, and why they should be very happy to be part of the Social Security system is that it's a huge life insurance program to take care of survivors. There's 10 million people collecting disability checks, but the lion's share of the folks in the system are taking retirement checks, 48 million of those. Add all those components up, you're at 64 million. And in every month, they're cashing checks that total $88.25 billion. An amazing number, because if you took that and multiplied that times 12, you're north of $1 trillion. So Jim, here's a quick question. Do we spend more on defense or more on Social Security in this country today?
Social Security.
Absolutely. It's 24% of the federal budget. This is the elephant in the room program. And how does it get its money? Well, it gets its money through taxes, these FICA taxes. 6.2% of your income up to the wage base is paid by the employee. The employer matches that 6.2 dollar for dollar up to the wage base. But in addition to that, you get to pay some Medicare taxes. And this is prepaying for Medicare Part A, 1.45%, 1.45% matched by the employer. For the lucky self-employed people on the call, you get to pay basically both sides of that tax. And then there's a little bit more good news on the Medicare side. If you have higher income, by definition over 250,000 filing jointly, you get to pay a 0.9% Medicare surcharge, which pays for, again, prepaying Medicare Part A. But Jim, the key thing to look at is that number in 2020. What is the Social Security wage base? Do you see it there on the screen?
137,700 down below, yes.
137,700. If your income goes above that today, you're not paying the Social Security component of that tax. That's not the case, though, for the Medicare tax. You take the Medicare tax on everything you make. So there's a big difference between these two things. Now, where do all those taxes go? Well, in some ways, they go right in the left pocket and come out the right pocket. $1.062 trillion flowed through the system in 2019. That's what came in. What went out is $1.059 trillion. And clearly you can see, simple math, we took in more than we paid out. We've been doing that since 1983. And income into the trust fund comes from three places. The majority of it comes from the FICA tax. Others come from interest on the trust fund, which is an interest-bearing government bonds. And the other comes from income tax. And right now, since 1983, we've been accumulating a surplus in that trust fund. And now there is almost count them with a T, trillion dollars inside of that trust fund, backed by interest-bearing certificates very similar to 10-year treasuries. The current interest rate on that treasury, which you can't buy, by the way, but it's sold by the Treasury to the Social Security Administration, is 2.8%. So 178 million people pouring money into this particular system. However, that's the good news, but there's also some bad news. The bad news is in 2020, we're going to start to tap into that trust fund. This is the first time we've done that to pay promised benefits. And everything would be great if we had an unlimited supply of money in that trust fund, but we don't. That $3 trillion is going to be consumed over time. And someone, we don't know who, will stand in front of the United States public, in this case 70 million retirees or beneficiaries on disability or beneficiaries from survivorship, 70 million of those folks in 2035, and say out loud that they're going to have to cut the benefits by 21%. What do you think, Jim? You want that job?
Well, thank you.
I don't think anybody on this call wants that job. That is a very difficult political problem. And it's not one that can't be solved, because it's been solved in the past. It was solved in 1983. Ronald Reagan was the president. Tip O'Neill was the Speaker of the House. They appointed an unknown business consultant up the street on 16th Street. First name was Allen, last name was Greenspan. And they got together a bipartisan commission and figured, well, we only can do two things. We can look at the revenue side, we look at the benefit side. So let's look at the revenue side. We've run focus groups in Boston and asked people, well, what's so sacred about that 137,700? What would you think if we increased that? And by far, everyone raises their hands and says, yeah, we probably ought to do that. But that's a progressive tax. Rich people pay that. The companies that employ them pay that. So Jim, is that an easy sale for you? What do you think?
Oh, it's one part of it anyway.
One part of it anyway, probably going to be hard, but the other one is equally as hard, is taking that 6.2% and moving it up to 6.3, 6.4, 6.5. So that's on the revenue side, but I can tell you this one is absolutely coming, which is over on the benefits side. You know, when my father started taking his full retirement age from Social Security, it was 65. Mine happens to be 66. For many of you on this call, it's 67. I think for sure for my son and for my daughter, their full retirement age is not going to be 67. It's going to be 68 or 69. So Jim, what's the solution here? One, more, or everything?
Well, probably a little bit of everything to cushion the blow.
Yeah, I think a little bit of everything. And if we do it and we tune it up, the system will be solid for the next 75 years. And there's current legislation in Congress before the pandemic hit doing just that out of the House Ways and Means Committee. I don't know when it's going to be turned into reality, but there is a ticking clock here. And 2035 seems to be the drop dead date for hard decisions to be made. Okay, what about basics? Oh, by the way, as we go along, if you hold a space bar down, I believe you could ask questions if you do have questions as we go. Think about this one. When you make money, you earn credits in the Social Security system. In this particular case, when you make $1,410, you earn a credit. You can only get 4 credits in a year, which means if you make $5,640, you've earned those 4 credits. And to get into the Social Security club, you have to get 10 years of credit. You have to accumulate these credits for 10 years because the magic number is 40. If you don't have 40 credits, you don't get retirement benefits. If you do, you will. I talk to many people all over the United States every day. And sometimes they have 37, 38, 39 credits. Is it really important if I go back to work and get those last credits? And the answer is yes. Not only is it important to qualify, but there's an interesting relationship in this system between how much you pay and how much you get out. The more you pay in, the higher the contributions, the higher the payout will be for you. 2 important terms to remember about Social Security, and you might want to make a note of these 2. And those 2 terms are FRA, full retirement age. And the other important term is PIA, which is kind of government speak for the size of your check at your FRA. Think about it this way. At your FRA, your full retirement age, you get 100% of your PIA, your primary insurance amount. And the PIA, again, is dependent on how much you paid in, but your full retirement age is based on your birth date. So for me, born between 43 and 54, my full retirement age is 66. Many of you on this call, if you're born 1960 or later, your full retirement age is 67. But if you're born between 55 and 1960, your birth date and your Social Security birth date is different. And you have to add 8 months. For example, somebody born in 58, their Social Security birth date at full retirement age would be 66 and 8 months. So write that one down. It's important for your clients to understand. All right, how much you get from the system depends on 4 things. When do you start? How much money you paid into the system? Your marital status, interestingly enough. And what did Aunt Ida Mae Fuller from Ludlow, Vermont teach us? Longevity. That's probably the biggest driver of these 4 in the particular formula. But let's talk about claiming age. We know that 69% of the people, and these are numbers through 2019, start their benefits at or before their full retirement age. And that's probably because they never saw this chart. And this chart is a really good representation of the importance of your full retirement age. Let's take Bob as an example. Hypothetical Bob, his full retirement age is 66 and 6 months. Think about this as a fulcrum on a teeter-totter or a seesaw. If his benefit at full retirement age, 100% of his benefit is $1,000. If he started those benefits at 62, he's certainly not going to get $1,000. there's an actuarial reduction that would drop that benefit to $725. On the other hand, if he started his benefits at 70, there is an actuarial increase, and those are called delayed retirement credits, 8% per year simple interest, that would increase the benefit to $1,280. So Jim, looking at this chart, who do you think might be inclined to start benefits early?
Well, someone who may be single, somebody who needs the money, and it depends on your health, if you have health issues.
Absolutely. I mean, absolutely. Remember Ida Mae Fuller's secret sauce. Who, on the flip side, who do you think ought to be looking at age 70?
You don't need the money if you're financially stable or secure.
Yeah.
And you're in good health.
And you're in good health, and longevity is there. And there's a range of choices. You know, the interesting thing is if you assume the projections for life expectancy based on Social Security actuarial calculations, whether you started at 62 or 70, you get exactly the same amount because you're supposed to die at 83 or 85, 83 for men, 85 for women. But see, we're not actuarial equivalents. We're all different. And therefore, the decision about when to start and how to take these benefits depends on something very unique. And that's you, your lifestyle, your DNA, your history, the things that you're doing in financial needs. So starting and when to file is basically a one-off decision that you can't apply to everybody. You also need to know how much money you're going to receive. And that is easy to find on ssa.gov, a fabulous website. I endorse it on every one of these calls that I make. There's an easy way to do it called the retirement estimator. You type in a couple numbers, put in your Social Security number, you get an instant answer. That's one way, but it's not the best way. The very best way is to absolutely establish a My account, a Social Security My account.
Right now. How's that going? Good.
Oh, Jeff, you have a question? I don't know. Jeff, did you have a question? Jeff Burke. Okay. Well, anyway, a My account. You can do this in about 10 minutes. And if you establish a My account, you can then print out your full Social Security statement, which I whimsically call the green line form. Why? Because it's got green lines all over it. And on this green line form, there's really some essential information. How much you're going to get if you start at your full retirement age, in this case 67, 70, or 62. Those details are important, and you can use them for planning projections into the future. A couple things to remember about that, though, is if you have to work, in this case to 67, to get $1,827, this person would have to work until they're 67 years of age. If they stop working at 62, they're only going to get $2,171. On the other hand, if they contributed it to the system and they took the money out at 70, it's $2,266. These do not include inflation assumptions, by the way. But there's another part of this green line form that you really need to check, and that's your earnings history. Every year you contribute to your Social Security taxes, they're going to be recorded on the green line form. And it's a good idea to see if there's any errors. Jim, do you think it's ever possible there could be a mistake on this form?
Yes, I do.
When we've done this meeting with groups of 30, there's 2 or 3 people in a group of 30 where they found an error. Jim, is the error in favor of the government or in favor of you? What do you think?
Always in their favor.
Always in the government's favor. My son is a good example of that. He found a significant difference on his earnings report based on last year's tax returns. The kinds of people that would see errors here get multiple 1099s, change jobs in the middle of the year, or make a mistake in filing their taxes. So that's a good thing to check. That's really important.
I have a quick question out here. It's,
Tommy, go ahead.
Yeah, real quick. Just so when you say you have to work till 67, in essence, it's self-employed or W-2 earners, as long as you're paying into the system. Is that really how you define work?
Yep, that's exactly right. Yeah, if you're collecting rents, royalties, pension plans, IRA distributions, none of that counts. These are W-2 based or 1099 self-employment income that comes in. So keep that in mind. So your earnings record is important. Jim, what's a good time to check this record?
Yearly.
Yearly, absolutely.
After you do your taxes, I would imagine.
Yeah, double check, just make sure it's lining up. Because if there's an error, you open up a window. 3 years, 3 months, and 15 days. One of the people on the call I did recently said, gee, I found a mistake 10 years ago. Can I fix that? No, just have to keep working to offset that. Remember, your Social Security income, the amount you receive, is based on 35 years, not consecutive, but highest years of your income. So you want to make sure that that's all going to come together and work that way. Okay, let's go to the next one. We're in the middle of a national problem. And that national problem is a scam. Scamming thieves. They're out there to try to take your money. Jim, let's do a quick role play. You ready for this one?
Sure.
So Jim, so you're coming back from a hard day at the office. You've got your iPhone there. You see this message. Somebody left you a voicemail. And here's the voicemail. Not exact, but pretty close. And I'm quoting it because I got this call. By the way, Jim, this is Dave Freitag calling. I'm calling from the Washington, D.C. headquarters of the Social Security Administration. We've discovered some unusual activity on your Social Security account in the state of Texas. We've therefore suspended your Social Security number. You must immediately call this 800 number to rectify this situation. This is an important call, Jim. Do not hesitate. Call this 800 number. Jim, have you ever had a call like that?
Yes, I have.
It's a national problem. And right now, if you subscribe to the blog account on socialsecurity.gov, you can see articles written about this. They're working with AARP. They're trying to stamp this thing out. But if you have a My account with a username and password, you've put security in front of those thieves and those phishing people. It makes it more difficult for them to get access to your Social Security number. So everybody needs to have their My account established. They need to put that username and password in place to make it very difficult for people to get access to those money and try to manipulate your Social Security account. Oh, by the way, in COVID times currently, there's been scams worked on Medicare claims. Again, important reason to have your My account set up. Okay, the longevity wildcard. Well, there is a calculator on socialsecurity.gov that will help you come up with a projection for longevity based on your sex and the day you were born. However, this is not all that helpful. What's much more helpful is looking at your own unique situation. Your family, mother, father, aunts, uncles, lifestyle. Because as Ida Mae Fuller taught us, it makes a huge difference on the filing selection that you would make for your Social Security benefits. So what about younger couples? And by the way, the definition of young today in the Social Security system is born after January the 1st, 1954. And here's Sam and Lee, a young couple in their 50s, and they decide that they want to look and make some planning for a Social Security filing election. Now, there's lots of math that goes on in making these calculations. We happen to use a calculator. This is actually a screenshot of that particular calculator, where we input some basic information. Sam's benefited his full retirement age. Lee's benefited her full retirement age. Some assumption for longevity, an assumption for cost of living. And what we discover in using this calculator is that there are 81 different age combinations for a younger couple on taking Social Security. And the variance between those 81 ages combinations is significant. If they started as soon as possible, the total payout at life expectancy would be $1.6 million. If they started at 70, it's $2,086,000. That's a delta that approaches $500,000, totally based on when they start, assuming the life expectancy holds. So people need to look at that. It's very hard to come up with a good strategy if you don't have some kind of analytic tool to help you do that. Here's an example of Sam and Lee saying, well, wait a minute, doesn't it make sense if we just took the money at our full retirement age? Well, they could do that. But again, they might be walking away from almost $200,000. For younger people, filing early with Social Security doesn't make any sense in general. If they can wait, great. If they got health conditions, they probably want to file early. But everybody's unique. We want to make sure we understand that age calculations and assumption about longevity is factored into that decision-making process. Okay, what about this one? Older married couples. In 2015, a massive piece of federal legislation came out, which introduced a bipartisan solution to the budget crisis that existed at that time. And in that bipartisan budget act, literally buried on page 800 of the act, was a grandfather clause that provided some extra benefits for people who were born on or before January the 1st of 1954. And this is an example of Bob and Mary. They were born before that date. They could do, in fact, something called a restricted filing. And the restricted filing goes like this. Mary would file for benefits on her own record. The only increases she would receive would be benefits paid by the cost of living increases. But Mary would open a magic window, and that window would be paid to Bob. That Bob window that he can now go through allows him to receive half of Mary's benefit. But in addition to that, earn delayed retirement credits at the very same time on his own record. That means at 70, he could get up to 32% more. Let's put some numbers in play here.
Yeah,
You can
just,
see
Dave,
Mary.
just for clarification, that's called the spousal benefit.
That's the spousal benefit. That's that 50% spousal benefit. That's good.
Yes.
Okay, so let's put these numbers in play and see how this works. So there's Mary collecting her $1,128. Bob gets half of that, $564. They would do that for 4 years. And then at age 70, the magic happens because Bob's benefit is earned those delayed retirement credits. His benefit goes to $3,500 a month, almost $3,600. Mary's benefit layers in, and they get essentially $5,000 a month in benefits. Now, Jim, if I came to your office today and said I needed a guaranteed life income with a 2% inflation assumption that would pay for as long as I live, how big a check would I have to write to get that guarantee?
Over $1 million.
Well over, north of 1.3 million. And so many people don't realize that Social Security is an asset of this magnitude. The truth is, if I took a suitcase and filled it with $1.3 million and dropped it on the front porch, you wouldn't casually care what happened to it. You would say, I better figure this out. So planning is really important. And there's another factor here in Social Security that people don't understand very well. And that is when you're alive, you get the money. And if you're not, you don't. The day before Bob died, they were getting almost $7,000 a month. But the day after he died, Mary's getting $5,100. And Jim, another good question for you. What's the probability that this is going to happen?
I'm going to say 100% there, Dave.
It is 100% certain to everybody that's married collecting Social Security in this country. And if you knew that that certainty was coming, wouldn't you do some preventive planning over here to make sure that this income loss was
Hey,
mitigated?
Dave.
Yes,
Just to
go
stop
ahead.
for a second. The question popped up, why is Mary's benefit increased at age 70? I guess we should reference the cost of living adjustment.
There's a cost of living adjustment, and there's a small spousal benefit that's also paid when Bob filed. And that's why it jumped up. And it was also cost of living, spousal benefit drives that. That's why it goes up to $1,358.
So just to clarify, earlier, Bob received a spousal from Mary, and then at 70, Mary's receiving the spousal from Bob.
A very small benefit in this particular
In addition
case.
to the cost of living.
Correct. In this particular case, that's the way that worked. So this is kind of the way the math works. This is the way the numbers. A great question, by the way. Keep them coming. If Bob and Mary said, no, we don't want to do any of that. We're just going to file early. We're going to do what Uncle Lou said at the family picnic. They could be walking away from over $200,000. If they're smart about filing strategies, it could mean a lot. I was on the phone today again with a couple, 68 and 67. Both had not ever heard about restricted filing. Had no idea how it worked, but were elated to find out that they had some choices that might be very attractive. Okay, if they both filed at 65, you kind of get the idea. Take a look at, by the way, Jim, at the spousal benefit, what Mary would receive after Bob died. You see that number?
It's cut off. I can't see it.
Can you see it now? 3671. Can you see that?
No.
You can't see that? You can't see that number? How about this? Can you see it now? 36. Nope. Did my screen sharing stop?
No, I can see that it's cut off by the pictures. Go ahead.
Oh, okay. Oh, the pictures are there. Okay, well, it's 3671. And compare that to the 5,000 that existed before, and that's a significant difference for Mary, based on 1 year of filing strategy adjustment, not understanding how restricted filing works. For same-sex couples, there was a huge law change. 2014, Supreme Court ruled that same-sex couples were the same as everybody else. That's good news and bad news. The good news is they're the same. The bad news is nobody understands how they work. So there's a very special page on SSA.gov just for same-sex couples, talking about how these benefits will enhance their plans for retirement. Now, what about divorces? There's a couple check marks to put on the divorce category. Born on or before January the 1st of 54. That's an interesting checkpoint. Married for 10 years, another checkpoint. Got to be age 62 or older. If you meet those requirements, it's actually possible for someone who's divorced to do restricted filing. Nancy, for example, let's take her. She could, in fact, take benefits from her ex-husband, Alan, collect those benefits from Alan, and earn 8% per year in delayed retirement credits while she's collecting those benefits from Alan, thus allowing her to earn up to 32% more at age 70. And the numbers here are really dramatic. If she just filed at 65, didn't know about this, the total payout could be 535. If she knew about restricted filing, the payout would be over 700,000. That delta of 171,000 is the difference between a filing strategy and 1 year. So important for divorced people to understand that strategy as well. You know, surviving spouses, I've been doing this. Go ahead.
And the key is that they stay unmarried. That they're unmarried.
Yes, you got to be divorced. They do have to be divorced. Good point. I'm glad you asked that. I've been doing this for a while, almost 8 years now, and I've not received as many survivorship calls in 8 years as I have since March. We've lost over 150,000 people who happen to be in this age category, and people want to know how survivor benefits works. So in this particular case, let's say Nancy were to lose her husband, Bill. She, in fact, could collect survivor benefits from his record, but at the same time earn delayed retirement credits on her own record, allowing Nancy to get an up to 32% increase at her age 70. If you've got people in this situation, you need to walk through the choices for survivorship. They're confused. People are really confused about that. And again, we can model the tool with software that shows, in this case, it might mean almost $100,000 more by following that restricted filing strategy. Single claimants, let's see, Jim, single claimants, it's not too hard for a single claimant to figure out what to do, right?
Particularly.
It's just based on what do you need. If you start early, if you start late, it's driven by longevity. So we don't do a lot of modeling for single people, but we do for married, divorced, and widowed all the time. There's some other things to keep in mind, and that's, of course, the dreaded earnings test. Anytime you take benefits before your full retirement age, you become subject to the earnings test. In 2020, it was $18,240. For every $2 over that amount, you get $1 withheld. On the other hand, the year of your full retirement age, it's 48.6. 3-for-1 relationship. For every $3 over, they withhold $1 back. And that applies to everything, whether those are spousal benefits, whether those are widow's benefits, whether those are your own retirement benefits. This earnings test is a real big hurdle put in front of taking benefits early. Then there's taxes, something else to keep in mind. And taxes were introduced in 1983. The IRS figured out how to make it work in 84, started charging them in 1985. And it's based on something whimsically called combined income. And by definition, that's adjusted gross income plus non-taxable interest plus 50% of your Social Security benefit. If in a married couple filing jointly, you're over 44,000, you could be reporting up to 85% of your Social Security as income. But I think it's important, Jim, and you and I have talked about this one, to put these in perspective. Jim, how much income would you report if you took $1 out of your IRA? How much would you report?
All of it, yeah.
But what about $1 from Social Security?
Less than 85%.
No more than that. It could be substantially less.
Yes.
And in retirement, which dollar would buy more? The IRA dollar or the Social Security dollar?
Social Security.
Yeah, because it's got tax advantage. So keep that in mind. And finally, there's a bit of state good news here. The state good news is some states, like Massachusetts, for example, are totally exempt from Social Security income taxation. Some are, some are not, but most are at the point of either now not being subject to taxation or transitioning to that. West Virginia is a good example of a state taxing away, moving away from Social Security taxation at the state level. So then we're going to put this all together, and we're coming up on 12:42, Jim, on my clock. So how are we doing time-wise? I think we're okay. It's not about the money. It's about health concerns. When do you want to stop working? Have you got any other assets? I use this saying all the time with clients. One size fits one. This is really an important thing to remember. You cannot take a rule of thumb and apply it to your Social Security filing strategy. It just doesn't work. It needs to be custom-made dress, a hand-tailored suit that specifically applies to the unique situations that individuals bring to the table. And also they need to understand how Social Security fits into the overall plan for income and retirement. I mean, this is the basic way we look at retirement. It's called the 4-box strategy. Over on the left, you see necessary expenses, discretionary expenses. On the right, predictable income and income from assets. What you have to do is balance predictable income against necessary expenses. And by far, often, the biggest predictable income source is Social Security. So if you don't get that one right, then all the rest of the decisions in the retirement plan don't make any sense. And here are some to-dos. If you don't have a My Account, get one. Make sure you verify the statement. Understand your full retirement age. Take a look at health, family concerns. When do you want to stop working? And project your retirement income needs and talk with a tax advisor. There are great resources available to help everybody on this call. SSA.gov I use every day, multiple times. You can, if you want, call the national 800 number, 800-772-1213. But because they've closed all the Social Security office in mid-March because of COVID, you might find that number a little bit busy. But what a lot of people don't remember is that the local Social Security office, the fact that it's closed doesn't mean that there are not people there. There are people there. And you actually can go online and find the local number of the Social Security office and call them locally with general questions. So those are resources that are available. And finally, if you have questions, we can have calls and we can talk to you and help you or help your clients figure out what their choices are. At the end of the day, this is always about putting the responsibility back on the shoulders of the clients, fitting in this important decision and making it simple for them to make a good decision. So there we are, Jim, at 12:44. Did we hit the number?
A minute to spare, and I think we've had a couple of questions pop up, so why don't we get those?
Minute to spare.
Thank you, Dave. I think Jeff.
Sure.
Jeff, do you want to pop in with your question?
Yes, hey, thank you guys. So the $48,000 max on income in the year of your retirement.
Yes.
What if you have someone retiring at the end of the year and they're making $200,000? Do you kind of request them to delay full retirement or turning on Social Security until next calendar year? What's your advice there?
Yeah, well, if you're making money and they withhold the money, you don't lose it. The interesting thing about that is it's basically like deferring your filing election. It's an interesting way the math works. It gets paid back to you, but it doesn't get paid back to you in a lump sum. I think there's one rule that you can apply to Social Security, and this is the one rule I always come back to. If you're working full-time and making good money, probably taking Social Security really doesn't make any sense. But at full retirement age, here's the good news. The day you turn your full retirement age, whatever that date is, there is no more earnings test. So a lot of people could, and by the way, the money you make before the day you turn your full retirement age doesn't count. It's the money you make after you turn your full retirement that doesn't count. Money before, but it's done by the month. So there's lots of different formulas. If you're interested, you can send an email to Jim and or Ed. I'm happy to send you along a little booklet from the Social Security Administration that talks about the earnings test. It's available online if you want to see it at ssa.gov. But the earnings test is a huge hurdle, and it's one people need to be cautious about. If you ignore it, and again, I had a call just this week on this one. Somebody ignored it. The government IRS computer got a direct line to the Social Security computer, and they'll pick it up via those Social Security 1099s they send out. And you get the dreaded letter that says we're stopping your Social Security benefit till the formula is equalized. So it's a real thing, and it's not going to go away anytime soon.
Thank you.
Go ahead, Tommy.
I don't have anything else. Is there any other questions, anybody, before we wrap up? You're welcome, Marcella, for sure. Ed, I don't know if you want to wrap it up, if you're how you doing technically, or I can handle it.
Well, how's my audio? Any better?
Oh, wow. What'd you do, Ed? Holy smokes.
I am back from the depths.
Sound much better.
So glad to be back and being able to be heard. So yeah, I'll wrap it up. First and foremost, I just wanted to thank Dave and Jim. This is a great presentation. We got a lot of feedback on this before, and and now after. And I think this is a very relevant topic that we can all benefit from. So thank you once again.
Sure.
I will let everyone know that we will be looking at the chat to see if there was any questions that were missed, but I don't see anything as of yet. We will also be sending out a recording of this video, and Dave and Jim have provided us with the presentation deck, so we'll send that along out. And typically what we'll do is we will copy Dave and Jim on that email. That way, if you have any questions, you want to reach out directly to them, you can definitely do so. I do want to mention quickly that Mass Mutual has been a good partner for us, and we have a growing relationship with them. And particularly in their life insurance, group life insurance products, and particularly one product where they have guaranteed issue on whole life that allows those that might have some difficulty getting life insurance on their own to be able to accumulate it for certain size groups. So if you have any questions about that, feel free to reach out to us, Dave or Jim. Also, I do want to mention that, and we mentioned this on the last Lunch and Learn, that Vanguard has now entered into a partnership with Ease to provide full benefit administration for all of our clients. This is really going to be help during open enrollment, streamlined during the year, because it will allow full ben admin access for the HR team and the employees as well, including mobile apps that they'll be able to use, and a very seamless virtual open enrollment process. So if you have any questions about that, let us know, and we will be reaching out to you either on renewal or prior to renewal to inform you of how we can implement that for you. I'll just check the chat one more time to make sure there's no questions. Don't see any questions, but I am seeing a lot of positive feedback. So once again, just want to thank Jim and Dave for a great presentation. We'll get this out to everybody. Dave and Jim, anything you want to mention before we wrap up?
Well, yeah, Ed, you're managing a lot of my money, so I want you to make sure you take care of it.
Thanks for having us, guys. Appreciate the opportunity. Hope you found it helpful. There's a lot to it. It affects everybody. So as Dave said, the ultimate responsibility falls on the individual, but there are resources, so please avail yourself of them.
Great. Okay, with that, we'll wrap up for today. Thank you, everybody, once again. Look out for our next Lunch and Learn. We have topics coming up on wellness strategies, on networking, on Medicare. So look out for our next invite, and everybody have a great